The stock market is exploding again. The S&P 500 just broke a brand new record high, the Nasdaq just broke a brand new record high, and the Dow Jones also broke a new record high. Now you might be wondering, well, what's the cause of this new boom in the stock market? And if you ask Wall Street, they'll tell you it's because inflation is finally cooling down. Now if you watched my video yesterday, which I recommend you do, or if you read market briefs, which I also recommend you do, what you'll find interesting about this is that inflation came in at 3.4%. Now sure, the 3.4 inflation number that we got is lower than the 3.5% inflation number that we got last month. But the real reason why this is so interesting is because when we got the January inflation numbers, they came in hotter than expected. The February inflation numbers came in hotter than expected. The March inflation numbers came in hotter than expected. And now when we got the April inflation numbers, they came in as expected. And because the inflation numbers finally came in as expected instead of hotter than expected, everybody on Wall Street got very excited. Now, I'm not going to do a whole deep dive of what causes inflation in this video because I've already done that so many times, but when you have more demand than supply, that boosts up the prices of things, because if you have a lot of people that are buying one thing, then that pushes the price of things up. Higher demand, lower supply, the prices of things go up. Well, pretty much all the recent economic data has been pointing to the fact that many Americans are starting to essentially run out of money. Now, while that might sound like bad news that Americans are running out of money, which it is, it was actually good news for the Federal Reserve Bank, because if Americans are running out of money, that means they have less money to spend, and if they have less money to spend, that would help cool down inflation, which is kind of like what we just saw happen. But also interestingly, you want to pay attention to what's happening, because we also just saw this huge rally in meme stocks like GameStop during a time where Americans were supposedly running out of money, and we saw many retail traders, regular people, dump lots of money into the stock. I mean, the stock value grew by over $1 billion during a time when Americans are supposedly running out of money. Now, I say all this just to make the point that there's a lot of uncertainty in the stock market, in the economy, which is why in this video I want to go over three things. Number one is what's happening to influence the stock market. Number two is the stock market going to keep rising and break new record highs? And number three is, should you be investing your money in the stock market during an all-time high? Now, I want to start by talking about number one, what's happening in the economy and the stock market, but I also want to remind you that just around the corner on May 21st at 8 p.m. Eastern Time, I'm hosting a live, free, and virtual stock market investing workshop. So if you have money in a 401k or IRA, or if you like investing your money yourself and you want to see how you can improve your returns or pay less fees on the funds that you pay, this is a free workshop. I promise you, you're going to get a ton of value out of this. I would love to have you there. All you got to do is register. It's free. So if you'd like to join me on this live workshop, I got the link for you down in the description below. So let's start by talking about what's going on right now in the stock market and economy to influence this new rise in the stock market. Now, I know I talked about this yesterday, so I'm going to do a very quick recap of where we are right now, because on one hand, we saw this inflation number come in at expectations, which got Wall Street very excited because they hope that if inflation is cooling, that means interest rates are going to get cut sooner than expected. If interest rates get cut sooner than expected, or let's just say sooner, that means that it's cheaper for businesses and people to go out and borrow money, and it makes refinancing the debt even easier, which could help stimulate the economy. Lower interest rates, more spending, more stimulating the economy. Higher interest rates, less spending, cooling of the economy. And if you're investing your money into companies, obviously you want a heating economy, you want a boosted economy. But at the same time, there are also concerns in the economy. What are these concerns? Well, on one hand, we're seeing the concerns that saving rates are falling in America. We're seeing that Americans are running out of money in some instances. We've been seeing layoffs rising in America, and we've also been seeing bankruptcies rising in America. That's why I say that it's a tale of two people that's been diverging. Let me show you what I mean. Over the last 5 years, between 2019 and 2024, inflation has been around 23%, the reported inflation numbers, which means that if you go out and spend $100 in 2019, that same thing should cost you $123 today. Now, I understand that for the average person, we've seen more than 23% inflation, but I'm going to go with the reported numbers. But during those same 5 years, incomes have gone up by around 22%, while the S&P 500 for investors have seen their investments grow by around 85%. What does this mean for the average person that's relying on their salary to get by? Well, guess what? Your wages are not keeping up with inflation, which means for the average person, you have less discretionary spending according to the reported inflation numbers. And the average person is facing much higher inflation than the reported inflation numbers. And by the way, in case you're wondering, where did I get this wage growth number? I got this wage growth number by looking at the Social Security Administration cost of living adjustments, because we're not going to see the actual wage growth for Americans for at least another year. So I just took a look at how much the Social Security Administration has been raising the Social Security payouts over the last 5 years. What this tells us is we've been seeing this divergence between the regular person and the investor. And we've been seeing this happen. This is nothing new. But this really got amplified after the pandemic, after the money printing, after the high inflation period, because what happened? Incomes went up. We know the wages have gone up, but they haven't gone up to meet even the regular reported inflation numbers. But at the same time, investors have been seeing their investments boom. That means for the investors, people who are financially educated, well, they have been seeing their wealth grow significantly, and significantly faster than inflation. But if you're just relying on your income, well, that means you have to use a bigger chunk of your salary to pay for your groceries, to pay for your rent, to pay for your car, to pay for your vacations, which means you have less money left over to save, and you have less money left over to invest. This is what's happening in the economy. And if you take a look at what's happening in the economy kind of in a snapshot, everything looks fine. And I keep saying this example because it's the best example that I can think of. If you have a better example, please let me know. But if you look at the economy in a snapshot, it looks okay because you see people spending. You see people paying their rent. You see people buying things. You see people shopping, and it looks good. But if you really take a look at what's going on in the broader picture, what you'll start to see is the reason why people are still able to spend is because they have the credit ability. They have the ability to go into debt. What we've been seeing happen is people have been digging into their savings, into their 401ks, into their home equity in order to keep spending, which sure, in the short term is fine. It allows you to keep going to Chipotle and buying the extra guac. It allows you to go to Gucci and keep buying the purse. It allows you to keep spending, which looks good on the economy, but does that mean it's okay if people are spending money they don't have? Because eventually you would hit a breaking point, right? Well, I guess only time will tell. And this is where what I want you to understand is the stock market is where people put their money based off of what they think is going to happen in the economy in the future. Now, of course, nobody can perfectly predict what's going to happen in the economy tomorrow. I don't want you to get in the game of trying to predict what's going to happen in the economy tomorrow, because just like how nobody can really predict the weather, no one can perfectly predict the economy either. But this is where you got to understand that the stock market and the economy don't always move linearly. The stock market is not the economy. The stock market is where people put their money based off of what they think is going to happen in the economy. If you believe that the economy is going to grow tomorrow and next year, you want to own stocks, because that means the companies that make up the economy are going to grow as well. But this is where you got to understand that you can see this divergence between the stock market and the economy, which brings me to point number 2 is, are we going to see the stock market continue to rise? To really understand this question, you have to understand what makes stock prices go up. So let me ask you, what makes stock prices go up? And you might say, well, if a company is making more money, the stock is going to go up. And the answer is not necessarily. Because what really makes the stock market go up is really not what's happening with the economy and with companies. It really depends on supply and demand in the stock market. If you have more buyers than sellers with the stock price goes up. And if you don't believe me, just take a look at what's been happening with GameStop. When you have more buyers than sellers with GameStop, the GameStop stock rises. Now, did the GameStop stock really rise because the company made hundreds of % more money? No, the reason why the GameStop stock was rising was because you had more buyers than sellers. And so just like every other asset class, your stock is worth what somebody else is willing to pay for it. Now, of course, you're ultimately buying an asset which makes profit. So the way that investors decide if they want to buy something is ultimately determined based off of the profit. Now, when you have these trades like GameStop, that's a completely different situation because people here are trying to trade and do something very different. But when we talk about investing your money for the long term, what you're looking for is an asset, an investment that you believe is worth your investment dollars. And if a company is making more money, if a company is making bigger profits and they're growing, more and more investors are likely to say, this company is worth my investment dollars. And that brings in more demand, more buyers for that investment, which then helps push that stock price up. So yes, a company making more money can help its stock price go up, but it ultimately depends on that supply and demand. So now when we talk about is the stock market going to rise, nobody can perfectly predict what's going to happen tomorrow Okay, so if you're looking for an exact answer, I'm sorry to kind of break the harsh news to you, but what you have to understand is supply and demand. And if people have money sitting on the sidelines, they have money to put into the stock market. And if people are optimistic, if people are hopeful, that gives people opportunity to put more money into the stock market. Which brings me to point number 3, which is, should you invest your money into the stock market during a time where the stock market is at or near an all-time high? And the reason why a lot of people get very concerned about this is because we want to buy low, sell high. Although a lot of people end up buying high and selling low because they don't have the right psychology and know when to buy or what to buy, but that's besides the point. But if you want to buy low, sell high, why would you want to buy during an all-time market high? And this is where you really have to know your strategy and your goals. Because if we look back to the previous recession, not the 2020 pandemic, let's talk about the previous real recession that our economy has seen. That was the 2008 Great Recession. Now, the stock market was breaking brand new record highs up through 2007. And let's assume that you bought into the stock market during the peak in 2007. During the peak, the S&P 500 was right around 1,500 points. But if you bought in during the peak and then you saw the stock market crash, you would be pretty devastated. But if you held on, by year 2013, your portfolio was now going up again because the stock market started breaking new record highs and now you were making money again. So what you have to understand is what you want to be doing is not trying to time the market, but rather understand that if you keep your money in the market for long enough, you'll be able to make money. But that also doesn't mean that you don't want to be able to take advantage of a market crash. So you want to kind of do this with a balance here. And the way you do that is by knowing your goal and by knowing your strategy. Because if you are one of those people that doesn't really care about monitoring stocks, you don't really care about researching companies, you don't really care about listening to earnings reports, then you don't need to be involved that much in the stock market. You can pick a system where every week or every 2 weeks or every month you decide money leaves your checkings account and is automatically invested into your portfolio of index funds, mutual funds, ETFs. It doesn't matter what's going on in the stock market. It doesn't matter if the stock market is breaking brand new record highs. You just start buying and then you keep buying. If the market goes up more, you keep buying. If the market goes down, you keep buying. If the market crashes, you keep buying. Because now you have a long-term strategy. And by long-term, I don't mean a year, I mean multi-decade strategy. That's how you build wealth with that strategy. It does not matter what's going on in the markets, whether you're at an all-time high or all-time low, you just keep buying. In fact, the only time you would change it is if you see the market falling. That gives you an opportunity to come in and buy even more aggressively. Now, if you want to be more involved with your investments, you want to be the person that's finding the right investment. You want to find the right company. You want to buy a company at an undervalued price. Great. Well, the first thing you got to understand is you got to be willing to put in the work. But when it comes to the actual practicalities of this, what's happening in the broader market doesn't really affect you. Because what you want to look for is the company that you're investing in a good price or a bad price? Because even if we take a look at the 2008 crash, there were stocks that were rising during the 2008 crash. For example, McDonald's grew by 7.5% back in 2008 while the rest of the stock market was falling. So what you have to do is be a little bit more picky. And this is the same whether you're investing in stocks or real estate. If you want to invest in an asset during a time where asset prices are all at an all-time high, you want to be looking for a good investment, which means you got to be a little bit pickier, which means you got to be a little bit more strategic. I mean, this is one of the reasons why Warren Buffett is sitting on an all-time high cash pile, because he's waiting for opportunities. He's waiting for the time where that you can come in and buy a good investment at a discounted price. Now, when you are in a time where market prices are down, it's much easier to find a great individual investment, because when stock prices are down, you can invest your money in pretty much anything as long as it's not going bankrupt and make a lot of money. When stock prices are up, you got to be a little bit more picky. And this is where now, if you really want to make money, you got to ignore the noise, you got to ignore the emotion and know what your strategy is. That way you can invest your money based off of what's going to be best for you. A lot of people get turned away, but what you want to know is what is your goals. If you're a passive investor, you got to just invest your money and understand what your strategy is. Now, I do got to give you a little bit of a disclaimer, because of course I'm just a random guy on YouTube. And you should never blindly trust a random guy on YouTube. You got to always do your own due diligence. And if you have specific financial questions, talk to a financial advisor in your area. But if you want to build wealth, you got to start by knowing what your strategy is, and then be willing to stick with your strategy even when times get tough. What the Federal Reserve Bank and Jerome Powell, who's the chairman of the Federal Reserve Bank, said is that they don't want to cut interest rates until they see inflation steady at 2%. or at least on target for 2%. And according to core inflation data, core inflation fell to 3.5%, which is still quite a bit away from the 2% target.